Okay, throughput accounting. It's a method of assessing performance in a just-in-time environment. The factory is considered as a single operation, and the focus is on the key constraint or bottleneck within the factory. All measures are calculated in relation to the bottleneck. Wow. Well, I look at this basic overview here, and what we've got to get straight first of all are some basic perspectives with regard to throughput accounting. The first is that we tend to find throughput accounting in a just-in-time environment. Now, if I say just-in-time environment, I know you all shout, no stock. Fine. We're operating at little or no levels of inventory. But when I look at just-in-time here, what I look at it is as a wider philosophy of how it is that you assess the performance of an organization. So the first thing I want to highlight is this. In a just-in-time environment, we don't want to break up a factory operation into its individual operations. Instead, what we want to do is we want to look at it as a single, coherent process. You see, the idea behind just-in-time is that we don't want to break up the process, but we want it to run seamlessly from beginning to end, from when goods come in and when products go out. Because the quicker that we can produce a product from this point to then, the more efficient we are being. So, the first thing is that we're looking at an overview of the overall factory operation. The second point that we want to pick up on is this. When we look at the process, we want to find which part of the process limits the overall level of activity of the operation. You see, as we go through all of those parts, we want to see, well, which part limits the opportunity for the organization to produce more units? By focusing on that limit, constraint, or what we call it here, bottleneck, we can say, well, nothing else within the factory really matters. It doesn't matter about the efficiency of other processes before or after the bottleneck, because the bottleneck dictates solely on its own the overall efficiency of the factory. So I'll say that again. We look at all of the individual parts of the factory processes and we identify which one limits the overall level of activity. We call this the bottleneck. No other operation is of any interest to us, on the simple basis that they do not dictate the level of efficiency of the factory, the bottleneck does. And therefore, whenever we measure anything about performance of the factory, we measure it in relation to the bottleneck. And that's our job done. What is the aim of what we're doing? Well, in a slightly cynical way, the aim is to calculate something called the throughput accounting ratio, to get that single measure of financial performance within the factory. And that is what we are progressively working towards. Right, one thing I want to get correct before we go any further is a brief look at terminology. The reason why I feel we must look at this is because we're going to introduce a few new terms, and I don't want you to get worried about them because they're all pretty similar to stuff that we already know. If you look at the right-hand side here, we have marginal costing terminology. You and I know that in marginal costing, we separate the costs into variable costs and fixed costs. We also have a fundamental measure used in marginal costing called contribution, and that is where we have sales minus variable cost. In throughput accounting, we are basically calculating very similar things. But instead of talking about variable costs, we now talk about direct material costs. The assumption being that labour costs are not variable anymore, because most operators do not work directly on the line, and most operators are paid in a salaried basis. So from that perspective, the only cost that is truly variable is the direct material cost. When we move to the fixed cost, well, instead of calling it fixed cost, what we're going to do is call it total factory cost. Again, essentially, it is fixed. But of course, the one thing we have to remember is that if labour costs are not variable, they must be included in the fixed cost. And instead of contribution, what we do is we calculate something called throughput, which is going to be sales minus direct material cost. So it's all pretty similar, it's just subtly different in the way it's described. If we were to briefly consider the conceptual basis for throughput accounting, the two basic things we have to consider are, first of all, one, cost behaviour, and we've just discussed that, and secondly, inventory. The idea that we do not wish to hold inventory. Holding inventory simply incurs cost. And of course that links it very nicely into the just-in-time type theories that we talked about. What I now want to do is to understand how we go about a throughput analysis. So I've given you a series of steps. Firstly, identify the system bottlenecks. Now remember what we talked about with regard to bottlenecks. What we've got to do first of all is to identify that part of the operation which limits the level of activity more so than any other part of the operation. 2, given that we have a bottleneck and it has a limited level of activity, we must ensure that all of that activity is used, so it's fully and effectively utilised. 3, all other activities can be scaled down in terms of production. For example, if our bottleneck says that we can only produce 100 units per week, there is no point having another part of the process being able to produce 200 or 300 units per week. So we scale down production of all other parts of the business, and so they are in sync with the bottleneck. And of course, by scaling down, we may be able to save on, say, labour costs or even maintenance costs as a result of the lower throughput that is occurring. So, what do we say? Identify the bottleneck, fully utilise the bottleneck, scale back production of all other processes. Then we say, well, is there any way that we could ease the bottleneck? Are there any internal things that we could do? You know, things like taking on more labour, buying a new machine, better training. Or are there maybe external things we could do to ease the bottleneck? What about outsourcing production, things like that? So, we focus on the bottleneck and say, how can we eliminate this bottleneck? And if we do that, then we move on to our final step, which is, well, this is a never-ending cycle. If we ease the bottleneck in one place, we will find a further bottleneck elsewhere, and we go through the same process again. So those are the basic 5 steps associated with how throughput accounting may work. Now let's look at the formulae that we're going to employ. We've got the return per factory hour, the cost per factory hour, and the throughput accounting ratio. Now if we look at the return per factory hour, what we're doing here is we're looking at what we earn from each unit generated through the bottleneck. And what measure of return do we already have? Well, if you remember back to the terminology, we had something called throughput. Yes? And that was like a contribution figure, wasn't it? So what we're saying here is, how much contribution do we earn per hour of operations? Then we look at cost per factory hour. Now, of course, if you think of the 2 elements of cost, direct material cost and total factory cost, direct material cost was included in the throughput measure, wasn't it? So the only cost we have to worry about is the total factory cost here. So we take the total factory cost and divide through by total factory hours. Now, notice the difference in cost behaviour there. When we're looking at the return per factory hour, what we do is we are looking at unit or hourly costs But of course, when we look at total factory costs, we're looking at them in total because they are fixed in nature. And then, once we've got that, we simply divide the return per factory hour by the cost per factory hour, and hey presto, we get what we were after, the throughput accounting ratio, TPAR. It's often abbreviated to. So, those are the formulae. Okay, so let's look at a question. Example 3, 3P3M. 3P3M produces 3 products using 3 different machines. The following information is available for a product for a period. So we're given the product sales, direct materials, direct labour, overheads. Ooh, it's all given per unit. Have you noticed? And of course, one thing we've got to be careful of here is to remember that labour is not a variable cost. We're then given estimated sales demand. Below, we are told the machine hours required by each unit. So in machine 1, X requires 6, Y requires 2, Z requires 1, that sort of thing. And we're told machine capacity is limited to 1,600 hours for each machine. So what do we have to do? Well, in very simple terms, we have to calculate the throughput accounting ratio and rank the products. Well, okay, if we're going to get there, do you remember what I said was the first thing we always do in throughput accounting? Well, I hope you did. The most important thing in throughput accounting is identifying the bottleneck. If we look at the information here, how do we identify the bottleneck? Well, I suppose what we can see is somewhere at the bottom here, we've got 1,600 hours. And then we're given information about each of these 3 machines. So presumably, one of these machines is going to require more hours than the others. And the one that requires more hours is going to be the one that is the bottleneck. Okay? If we look at the analysis, what I've done here is I've taken the hours per unit and multiplied by the number of units. In this case, the number of units for each product was 200, which makes life quite easy. If we do that, we sum the total hours. And what was the amount of hours available for each machine? Well, we said that there were only 1,600 hours available. So if we divide the machine hours we want compared to those available, what we see is, well, we have 2 machines where we're using more hours than those available. Well, the first observation, of course, is machine 3 cannot be the bottleneck because we've easily got sufficient hours. Given that we have 2 machines that breach the number of hours, we would opt for the machine that uses more rather than less. And what we see here is that machine 2, because it's at 169% of capacity, will be our bottleneck. Now, to my mind, if we got that, we're sort of close to nailing the question here. Okay? Looking at calculating the return per factory hour, all it's going to be is sales minus direct materials. That gives us our throughput. Now, that's throughput per unit, isn't it? And once we've got our throughput per unit, then we can divide through by the hours per unit to get the return per factory hour. And what we see here is that, wow, some products do earn a far higher return than others. So if you wish, the return per factory hour is how much we generate from each of those scarce hours in our bottleneck resource. Then we look at our cost per factory hour. Now hold on a moment. What we've done here, if you notice, is that these are the costs for both labour and overhead, because they were both expressed per unit. So, if we look at X, 5 plus 2 is 7, multiplied by the number of units gives us a total factory cost of 1,400. Therefore, the total factory cost is 2,800. And how many hours were there? Well, yes, there were 1,600 hours, weren't there? Therefore, the cost per factory hour is 175, and that will be the same for all of them. And that's quite common, so we tend to calculate a cost per factory hour for all of them in total. So, we're now able to calculate the throughput accounting ratio. Simply divide the return per factory hour by the cost per factory hour, and we get a throughput accounting ratio of these numbers here. Now, what can we do with those numbers? What do they mean? Well, presumably the higher the throughput accounting ratio, the better. So we would say that product Z would rank higher than product Y, would rank higher than product X. But what's the critical number? Well, the critical number is 1. If we have a throughput accounting ratio of greater than 1, that means that our throughput, remember, contribution figure, is greater than our fixed cost, total factory cost figure. Throughput greater than total factory cost means that we're profitable. Less than 1 and we are loss-making. Okay? So if we look at these products here, product X does give rise for concern. Okay? What we could do, of course, is we could then go further and say, well, hold on a moment. We've got a limited number of hours. And given that we would rather produce Z to Y to X, presumably we could look at our production process by saying, well, look, let's produce 200 units of Z. If you look back, that would require 300 hours in the bottleneck resource. That means that we've got 1,300 left over. We can produce 200 units of Y. They require 600 hours. That means that we've got 700 left over. And if we use 700 hours, we will be able to produce 77 units of X. So one thing we could do here is a classic little limiting factor calculation to use up the resource in the most efficient manner. So when we look at throughput accounting, the key is understanding what you're trying to achieve. The first thing we have to remember is that you cannot go anywhere in the question unless you've identified the bottleneck. And remember, if you've identified the bottleneck, any subsequent calculation will be in direct relation to that bottleneck and nothing more. Secondly, you've got to make sure you can calculate the throughput accounting ratio. And thirdly, you've got to be able to interpret the information for the wider discussion.